Hello and welcome back. Welcome back to our update on private equity and venture capital trends. I just returned from conversations with institutional investors in Switzerland, and I thought I should share a few of the conversation points that came up in those talks. So, one of the questions that was asked is it time to allocate to private equity? So, let me basically walk you through a couple of data points and then very quickly go beyond the data. So, question right now we saw in the earlier talk is the industry continues to grow, has raised tremendous amounts of capital over the last 20 years. Naturally, dry powder has increased, the money that's sitting on the sideline waiting to be deployed. And that obviously, the activity as well as dry powder and the number of private equity firms increasing has basically pushed valuations up. Nevertheless, as we stand in early 2023, valuations are coming off and will continue to decline until summer. Now, what is happening? In 2021, deal value crossed $1 trillion for the first time in the history of private capital. As we are looking at 2022, the year obviously had to start off with a softening. So we saw transaction value drop to 700 billion, but also a couple of interesting changes. 40% of the deals done in leveraged buyouts turned out to be take privates, meaning the action where leveraged buyout funds take publicly listed companies and take them private to improve them, to potentially increase their value again. That is kind of unusual, 40%. Usually that number is rather around 20% when we look over the years. Also, 60% of the transactions were add-ons. That number usually hovers rather below 50%. 22-23, activity started to continue to decline. So second half of 2022 and all the way into 2023. So clearly there was very cautious activity, partly due to macro, but partly also due to the, obviously on the sideline, requests from LPs to take deployment or capital calls a bit easy. Obviously, the LPs are feeling the heat as well, or still from the development on the public market side. And the denominator effect is coming in as well, where due to drops in public market, the percentage allocation of total AUM to private equity is all of a sudden potentially high or higher than targeted. Of course, inflationary pressures plus rising interest rates didn't help. The question obviously that always comes up is, will capital continue to flow into private markets? As we discussed in the past, we've seen fewer companies listed on public markets. So obviously any global investor who has a mandate to allocate globally has to ask himself, does a public market portfolio truly reflect what is happening on the macroeconomic side? Or do we need private market allocations to ensure that our investment exposure will take advantage of any potential upward movement in those respective countries? And clearly, when we come to emerging markets, without private equity investing, without private market investing, it is really hard to argue, because more often than not, the public markets are just not representative. They just don't reflect what's going on the ground. Now, LPs that have clearly said that they are still looking for managers to identify, have potentially identified managers, and are to some extent excited about the opportunity to enter the market at a lower valuation. Until right now, in May 23, we have not seen this playing out, really not. And quite a few have basically allocated to private equity, but again, are waiting on the sidelines to decide what to do later in the year. You will recall that a few years ago we had an analysis done by State Street that basically looked historically over 30 years back and explored, is private equity really still outperforming public markets? And as you can see, when you look at the slide from far right, which is 30 years ago, where the green bar, US buyout funds, clearly outperformed public markets, the S&P 500 public market equivalent. Going all the way to the left, you can see that the delta between the dark green bar and the light gray bar is clearly decreasing and potentially even non-existent. Now, whilst this is certainly something to consider and to observe and to continue to explore going forward, we got to be aware that this is really an American story. When we look at Europe, in the middle on your slide, and you look at 20, 10, 5, and 1 year horizon, the delta between public markets and private equity is still quite significant for buyouts. And Asia Pacific, I flied it in on the right side as well, whereby I would be a bit cautious there because clearly 20 years ago, private equity was nowhere near what it is today in Asia Pacific. But clearly are private equity markets continuing to outperform, or will they outperform? Public market discussion should be held much more with a close eye on your US exposure. A couple of trends to watch just for those potentially for the next YouTube podcast. On the left side, secondaries continuing to grow. No surprise, usually when markets or when investors feel they want to reallocate their investments in private equity, secondary funds do well, but we expect those to grow, continue to grow. As I mentioned before, we're seeing attractive valuations now. Long-term funds continue to be interesting. So whilst this started only about 2015, where funds raised for more than 10 years, so 15, 18-year funds, it's very clear that the investors like this right now because they offer diversification. And then PE fundraising obviously continues, but this is not the case for VC, though there's a bit of a digression here. On the right side, though, worrying factors, obviously we're going to see fewer exits. That means LPs will remain in negative cash flow territory for a while to come. And VC funds are continuing to slowly or to stop fundraising for a while. But again, investors are watching there whether or not VCs will come back to actually deploy capital again. We've raised record funding in VC in the last couple of years, and that money has just not been put to work in the first half of 2023. Can investment in private capital be timed? Here's the billion-dollar question. Can you time investment in private equity? The answer should probably be positively not, but let's be a bit more polite, maybe not. So why is that? Well, historically, this is a very long-term chart going back all the way to 1993. When we look back in time, and especially when we look at cash-on-cash returns, the vintages that started deploying after a downturn in public markets usually outperform the decade within which they're playing. So allocating to private capital when times are a bit tougher, when others are not deploying, is arguably the time to build, expand, or even step into private capital. On that note, thank you very much for joining me. I look forward to having you back in our next discussion where we may take a closer look again at secondaries, since that presentation was quite successful a few years ago. Thanks very much, and please subscribe below.